Well, hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With the Bank of Canada lowering rates by 25 basis points today to 2.5%, how might investors take this on board with their investment decisions? And as we mull through some of these big central bank decisions being made and their effect on the broader economy, we're going to dive into the incredible interest in ETF investing, which remains very strong across this country. In fact, Fidelity's all-in-one ETF lineup recently crossed a significant milestone, $10 billion in assets under management since inception. So what's driving the popularity of ETFs, and more specifically, Fidelity's all-in-one ETFs? Which factors may perform well in today's market environment? We'll go through all of this with someone very excited to be joined today by Étienne Joncas-Bouchard. He is Director of ETF and Alternative Strategies here at Fidelity. Warm welcome to you, Étienne. I think you just did this en français. We're glad to have a moment with you.
Yeah, absolutely. This second show back to back, and glad to be back on and share some insights with our audience.
Delighted to have you here. Okay, well, and everyone can send questions in for the next half hour or so. Any questions that come across. I wonder if we begin broadly with sort of the macro story, because it is central bank week, and particularly today. So just your thoughts on kind of steadying the ship to the way you invest, as we do see, it seems like shifting sands throughout the economy.
Yeah, I mean, it's been obviously so far this year quite a whirlwind. I mean, we've had many distinct phases, anyways, from our perspective, when we look at it through a factor, lens, if you will, from an equity perspective, and that trickles down from anticipation of where economic growth is going to be going, where assets are going to be going, where earnings are going to be growing faster than other areas, and obviously central banks play a role in the anticipations of what markets are going to be pricing into their valuation models, what they're going to be pricing into their anticipation of economic growth, which eventually obviously trickle down to the portfolios and ETFs that we manage. And I'd say obviously, we've got another big decision. You mentioned the Bank of Canada, got another big decision coming up with the Fed. I'd almost, obviously from just a broader global market perspective, I think the Fed having a larger impact. Markets are basically telling us that we better see a cut. There's an anticipation, I'd say more than on the options market, there's a higher than 100% probability that we get a cut. So obviously having something else than that, I think would be a major surprise and would have probably somewhat of a negative impact on global risk markets, as much on the bond side as on the equity side. But overarching theme from our perspective is that there's somewhat of a continuation of a late cycle environment globally. We have seen some things work in Canada and international markets that are telling us differently, and maybe we can get into that a little bit later. But sure. Really on the U.S. side, things that have worked are extremely momentum driven, concentrated return streams in underlying indices. These are all themes that I feel like we've been talking about for the past 3 years now, but have continued to manifest themselves throughout this year.
And as you say, some really interesting sort of factor nuances that we will discuss in just a minute. Does that really land at this point? Do you feel like that is not just a theme for this year, or it's a few months? It's something that there's been a meaningful shift for, I guess, the long term is what I'm asking you, into international.
It's a great question, and even here at Fidelity, we'll have differing opinions. We can talk to certain portfolio managers, active portfolio managers that do have, say, an overweight exposure to international markets relative to what they've had in the past, and that they believe that this equity market performance will continue, which would generally entail that we expect flows to continue, flows tend to follow performance. So from that perspective, I think that's interesting. On the flip side, you have seen U.S. equity markets since April really catch up to international markets, and vice versa. You've seen U.S. equity flows slowly start to play catch up this year. But there's a lot of tailwinds / catalysts that it feels like are a bit more in play than they were before, because it's always been the story that international markets post-Great Financial Crisis feels like for a long time they've been trading at a discount, and especially post-2012, let's call it, when there was the European banking crisis, 2011, 2012, there has been a discount on especially European equities, emerging market equities relative to the US. But it was lacking a catalyst to consistently catch up to valuations that we're seeing in the U.S. equity markets. Obviously, earnings growth being the number one player there.
Right.
But it seems like there has been a change in tone, anyways, with regards to what Europe is going to be doing in the next 5, 10, 15, 20 years with regards to spending, with regards to their monetary policy, which is now a lot easier, obviously, than what we're seeing in the U.S.
Right.
You've seen weaker USD. That's a big help to a lot of the international markets. So all these things are kind of coming together right now, but I don't know if I can make a call that it's going to be super persistent or not, but I wouldn't be surprised to see this continue just based off of the fact also that I think those regions have been really underweight in a lot of Canadian investors' portfolios over the past decade.
Right.
Understandably so with
Right.
the performance that we've seen, but I think that's way below, say, what a neutral target would be for a global strategy.
And it points to, I wonder if this is a moment to take a look at the factors and take a look at sort of the business cycle slide that you've got. But you've noted that momentum is still momentum, and it's still a very important factor to take a look at. But sometimes the momentum of the types of stocks in different regions has been different. In the US, momentum means tech and everything that gets dragged along with kind of the AI theme, and other things are attached to that. But Europe doesn't have a whole lot of that, and they have some momentum going, but they're different stocks, basically, right? Is it?
Yeah, it's a great point, and actually, we can throw up slide 2 while we're addressing this. But this is a slide that we use very often in order to try and obviously, like, the data that we use to support trying to understand where we are is not reflected on the slide, but it's a very oversimplification of this. But like, factor performance is also very telling of where we are from a market cycle. And right now, to your point, is momentum is working everywhere. The issue, or not the issue, but the reality is, though, is that momentum looks very different from a region to a region, which kind of leads us to believe that international and Canadian markets, what they're seeing is that while momentum is working, so is value. In the US, that is not the case up until, I'd say, the last month, where we've seen somewhat of a broadening, but it was basically momentum was growth. But in 2 other markets, momentum's been more the value side. So, overweights the sectors that are more cyclical, like financials, industrials. You've also seen, like, energy, for example, in international markets doing quite well. But there's more overlap between our momentum and value factors in international Canadian markets, where in the US it's not so much the case, which would then indicate that maybe it's more of a late cycle environment, because a lot of those mega cap growers do have a lot of strong quality characteristics, which is also a factor that does well in the late cycle. Now, this is not like a call to say, one way or the other. It's more kind of something that we've noticed, and we're taking, we're kind of looking under the hood to try and figure out exactly why this is happening. But a lot of that, I think, has to do with monetary policy, and kind of a bit more as we've seen economic growth slow more in Canada and international economies. It feels like maybe there's somewhat of a bottoming out there, and it's not to say that we're reaccelerating by any means right now, but there is maybe an anticipation that it will reaccelerate slightly before the U.S. does, as it hasn't maybe hit somewhat of a bigger slowdown. So that's definitely an interesting development, I think.
It's fascinating that you pointed that out, and that it, you can see it right there on that slide. You mentioned that perhaps the monetary policy is part of the reason where we are right now, certainly. But the fiscal policy seems to be what will kind of take over and is adding to some of the momentum, undoubtedly, because there are all kinds of promises across Europe of fiscal expansion, and also Canada as well.
Well, I mean, if we look at international markets, like the sectors that are working, it feels like it's all tied to kind of this
government spending,
I guess, change in fiscal policy that we heard about at the start of the year. And I mean, we did see some implementations in Germany and things like that, but I mean, we still need to see the goods to see, that roll into the earnings of these businesses, where right now it feels like it's the anticipation of those earnings to come. They better come, because otherwise we might face more challenges. But like, sectors that have done really well in, like, say, the MSCI IFI index, you can look at financials are the #1 leader. Industrials have done really good. Energy, I mentioned earlier. In the US, it's tech, comm services. In both places, consumer discretionary has not been good. Maybe understandably so, with everything that's going on with tariffs, maybe prices and inflation on certain goods and things like that. But it's very different sectors that are working, which then manifests itself through factors, which manifests itself through indices, and et cetera, et cetera. But you have seen these wide differences in performance, which once again, it's not something that we see very often, so we do point it out.
Yeah, that's
But
really a
the one,
fascinating piece.
yeah, the one guideline though is like, or I guess perspective that we can provide is just momentum has worked everywhere, and that's really uh, it's a challenging environment for us in a certain way because if only momentum is working for Canada International, I mentioned values, like it's picked up value, which value is doing well as well. But in the U.S., when you're in an environment where only one of say our four main factors that we employ in our regional equity ETFs or our all-in-one ETFs, that's a period where there's a bit more, I guess, reliance or betting on beta, where it's basically, if it's volatile, it's going to help my portfolio. If it's not volatile, I don't want it. I don't want defense. You look at some of the sectors that haven't worked in the U.S., it's all the defensives. So there is a risk appetite when markets are rallying, and there's anticipation that things are getting better. Maybe rate cuts are coming, et cetera. But it is a little alarming that there's also been this much concentration, especially in the U.S. market. And it's not to say that it can't continue, but eventually there is a phase where there's a return to a broadening out. And I feel like I've said that, like, I feel like a broken record, but on average, if I look at all the calendar years of our back-tested indices that we've constructed on the factor side, on average, there's about 2.8 of our four factors that outperform in a given calendar year, and that's true as much for Canada, US, as international. So in a year when you only have one, that's more of an anomaly than something that's a regular occurrence, which historically we're talking closer to 3 would outperform the broad market cap weighted indices that they compete against.
Well,
So
I wonder if there we can talk a bit about the way you construct the all-in-one ETFs. Remind people, for those that don't know. I mean, there are many ways to sort of begin this, but one of them is that you do have exposure to all of the factors for a lot of different reasons, because most years, as you just pointed out, are a little bit of everything. And so you just kind of leave that exposure across the boards. How are the all-in-ones constructed? Just give us the 1, 2, 3 so we can kind of pull some of the threads on the stories of how they've been doing.
Sure, yeah, we can definitely pull up slide 3 to just show the entire lineup of portfolios that we've constructed. I guess there's a few key points that we thought of when we're constructing these portfolios. First of all is global diversification. So these are globally diversified portfolios. We've got U.S. equities, Canadian equities, international equities, global fixed income, Canadian fixed income, et cetera. We're trying to cover all bases from that perspective and an asset allocation perspective. The second most important is style diversification. It's something that obviously we've done extremely well from a historical perspective in our managed portfolios, our private investment pools that are actively managed by our global asset allocation team. Well, they're going to combine managers, active portfolio managers that have complementary styles in order to reduce volatility and enhance diversification. It's the same concept that we employ here with regards to factors, where a value factor is generally complementary to quality. Momentum is generally the opposite of low vol. That diversification adds a lot of value to the portfolio. And the reason why we're taking exposure to all of these factors in a more equal weighted approach way is that we know that these work over time, but as we saw in the cycle slide, they don't always work at the same time and they don't work all the time. So a great quote that I like to share is, factors work over time, not all the time, right? So having exposure to all the different factors allows us to capture that strategic alpha that they should generate over the long term without having the risk of being put in a corner because we're overweight a given factor. Like, yes, obviously we would have loved to be way overweight momentum, but if we go back to March, we would have loved to be overweight low volatility and value. So the way that we've approached these is that we got strategic management, we systematically rebalance them, turnkey solutions that have, obviously now we have 6 options, so ranging from 100% fixed income to 100% equity. And they've really become the flagship part of our lineup in terms of flows, also obviously in terms of performance and recognition, being really top performers in their category.
And they seem like flagship funds for a lot of investors, because 3 of those that we just put out, I wonder if we can just stick those up for one more minute there. 3 of those have been in the top 20, you said, that made it into the top 20 of the course of the last month, year, remind us?
Last year to date, but even FBAL, FGROW, and FEQT, I don't want to get this wrong, but I believe for August, they were 4th, 6th, and 8th best-selling ETF in Canada. So really like we were in the top 20, but I would have loved to be able to say we're in the top 10 year to date. We're not quite there yet, but
Give it
who
time.
knows what the rest of the year holds. But yes, they've definitely been widely adopted among the advisor community, using them in various different ways, right? As core in a portfolio, but also we're getting more and more demand for FEQT, our all-in-one equity, as just a global equity mandate that's very core. Obviously because of the different factor exposures, you're bringing yourself more to a more disciplined sector allocation strategy, if you will, where we're not taking significant deviations to our benchmark, but we are trying to win on security selection, which is kind of the name of the game for factors.
Okay, well, let's go into that. Security selection, how many, if you take the sort of equity sleeve or that particular fund, which is all equity, it's not passive, so you're not just owning every single equity that is in an index, for instance, but bring it home for us. How many are there?
It's a good question. I mean, it's going to vary big time when you include fixed income relative to the all-in-one equity. But if I look at just let's take like our balanced ETF portfolio, the FBAL all-in-one balanced. It's kind of the one that holds everything, right? Because it is right and down the middle. That one will have between, let's say, 2,000 to 2,500 holdings, which sounds like a lot. But if I compare it to our main competitors in the space, which use passive building blocks and index-based products, another way that I kind of describe our process, other than a funnel, which realistically it is a funnel, right? We're trying to get the best securities possible, but a lot of the work that we do is not necessarily in saying we are going to pick the best stock or the best bond, is using these, quant screens, factor approaches that we have, we're able to eliminate a lot of undesirable companies, right? Like it's easier for us to spot rotten apples than to find the one that tastes the best, if that makes any sense. And that allows us to generate alpha over time, because if we're able to find companies or eliminate companies, I should say, that, so don't screen well for any of the factors. So let's just hypothetically say a company that's volatile, non-profitable, so quality, it's expensive, it's not value, and it hasn't had momentum because it hasn't worked recently. For us, that company, there's very little chance that it ever finds itself in our portfolios. And I would argue that many advisors, many investors would say there's no real fundamental reason to own a name like that. It can work in certain phases of the market, like when everything is going up and there's, it's just getting dragged up, a rising tide lifts all boats type thing. But over the long term, those types of companies generally will underperform,
sure,
versus its peers, versus the rest of the index. So that's a lot of the work that we do, is filtering out a lot of the less desirable names.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
It's fascinating. And also when you go to the equity side of things, and even if you're taking a look at sort of the all-American, it's always been surprising that you have exposure to the Mag 7, but not as much as others, and they've done so well. I mean, I wonder if you could sort of talk a little bit about performance without massive exposure to the Mag 7. It's sort of a fascinating, feels pretty unique, actually.
Yeah. Absolutely, and obviously it's been top of mind for everyone since 2023. It's funny because since 23 we've had 30 to 35% of equities outperforming the benchmark, which is historically we're closer to 55% of equities outperform the broad benchmark. It's been 30% for the past 2-3 years. So for us, from that perspective, it's interesting because our approach will lead us to own these names for a multitude of reasons. One, they're extremely big companies. Will we own as much? Very rarely will we own as much of the very top of the indexes, for the simple reason that they do have to screen strongly from a fundamental perspective. And obviously they've screened well for momentum. So a lot of them screen well for quality, but they definitely don't screen that well for value and for low vol, right? Because they have been fairly volatile to the upside, thankfully for the most part. But nonetheless, that still displays volatility. And I will say that in our all American equity ETF, we have, I think we're close to about 22% let's say 19 to 22% exposure on a given day, relative to more than 30 for the benchmark. We still own those names quite handily, but we don't own as much as the index, and that's from a risk perspective, I think something that's fairly diligent.
It's interesting. How would you sort of discuss the way investors are buying risk right now? I mean, it seems like momentum tells the story to a certain extent that they are interested in buying risk. But I'm just wondering, from other stats that you get from various investors, is there a concern about what comes ahead, or a lot of investors looking through the next period if there is in fact a bit of a slowdown? That's certainly being discussed in Canada. It's also being discussed in the US, but equities often look through that. Is there any tepidness in terms of risk, or investors are buying risk? That's really what we take from momentum.
Yeah, no, it's yeah. I mean, it's fun to buy risk when things are going up.
Yeah.
But then there's always pullbacks. There's always, I think the anticipations now that we have around monetary policy in the U.S. with the Fed, like if we get a hawkish and kind of defensive Fed, like that could be a little bit of or definitely be a big holdup for a lot of these growth names that have outperformed. And I'm not saying that's going to happen. Like for all intents and purposes, the market's anticipating. And by the time we're recording right now, we do not have the decision in front of us.
Yeah, but it's almost the path ahead, isn't it?
Absolutely. But so for us, it's more thinking like it's okay to take risk. It's okay to benefit in rising markets, but we're always thinking of the long-term picture, where we don't want to make sizable bets, where we do want to make some bets. And I'd say over the long term, our approach of, correlating to our benchmark, but trying to we try to do a bit better on the way up and a bit better on the way down, but we're not trying to shoot the lights out in an upswing market, and we're not trying to protect 40% to the downside, 40% of the downside of the market either, right? So we're going to be fairly close, but that allows us to participate in upswings, but it also helps us protect a bit in the downside. But I would, momentum shifts so fast. It can happen in the blink of an eye, where we go from momentum works like we saw in March, and then next thing you know, it's the worst performing factor. And hence why, like every day that we receive inflows in our portfolios, we're allocating to the factors that have underperformed. So right now, when we get, trades from our advisors, from investors, we're not buying more momentum. We're buying a bit more low vol. We're buying a bit more value to come and try to keep this as close to a neutral mix as possible, in anticipation that there will eventually be some volatility.
So just going back to sort of big bets one way or the other, this is a good way perhaps to not do that, but just discuss what April was like a little bit, because it was an opportunity for many in a lot of ways, but it was also one of those moments where you're trying not to catch a falling knife as well. Tell us a little bit about how the funds performed, and different ones will perform different ways, but how they're designed to perform through real disruption.
Sure, absolutely. We could throw up slide 4, and I'm sorry, I'm having a really hard time understanding some of the audio.
There's a little bit of an audio thing there, yeah.
So one of the slides that we love to share, and we've now put together for our audience, and this is obviously as our last reporting date. Just to explain kind of what we're seeing here is the attribution summary for our all-in-one balanced ETF, which basically highlights all the individual ETFs and positions that we have in the portfolio, and then their contribution to total returns. So the blue lines reflecting absolute contribution, which is if you add all of those up, it gives us our total return that we see at the top. And then all the green lines is the added value, or I guess detracting, that we see relative to our benchmark. So any line that's above 0 that's green is adding value. Any line that's below is taking away some excess returns. And the one consistent message, which we've already mentioned a few times, is really, momentum has done really well, as much on the Canadian side as U.S. momentum, or U.S. and international momentum as well. So that's the tickers FCCM, FCMO, and FCIM. We have also seen, just on the international side in general, like that allocation, because of the performance of those markets, has been really, really good. We're not necessarily we're comparing to a benchmark that has a neutral allocation to international equities that we would have in the portfolios. But because of slight drift, we are slightly overweight international, which has helped. And then obviously, Bitcoin on an absolute basis has been positive, but on a relative basis, our benchmark does include Bitcoin. But relative to, say, our peers or competitors, that is one thing that's been adding a little bit of value as well so far this year.
That's great. There is a question rolling in. This is kind of how you consider currencies, what you have to do when you're building these products. How do you incorporate that or consider that?
Yeah, so we consider currency and I'd say this is not necessarily a decision from our end, it's more from the portfolio managers that manage some of our fixed income strategies inside the portfolio. Anything that's outside Canada on the fixed income side is hedged. For the most part, I'd say there's very little flexibility there. I think our Global Core Plus bond is the only one that has some flexibility, while the others are fully hedged. While we look at anything that's equity related, we are unhedged. So obviously, the depreciation of the US dollar here this year has been slightly a drag on performance if we're comparing to something that was hedged. Our benchmark obviously is unhedged given what we do, but and I'd say this is really kind of a standard across the industry. I don't know many ETF portfolios available on the market that would hedge their equities as much on the international side as on the US side. We have seen in the past some on the international side, but we actually see that one as a particularly additive, I guess, call, if you will. Just the diversification effect that we get from a basket of currencies instead of just the CAD to USD direct relationship, which can be good or bad in any given year, it feels like. Where international, it does add a little bit of diversification, having exposure to a multitude of currencies.
I wonder, just as we ask a final question of sort of what you think you want to leave with investors right now at this kind of interesting moment in the economy, for sure. Maybe we'll stick up the all-in-ones. This is slide 3. Just so people can have a quick look at the different funds themselves. But what would you like to close out with as kind of a message to investors, Étienne?
Final message, I think, well, first of all, it's a big thank you. I think it's been an exceptional year for us at Fidelity, and I'm sure for most people who've used our portfolios or our ETFs are very happy with the performance that we've delivered. We're extremely excited about the future. I will say keep an eye out for more innovative solutions that we're going to be coming out with this year, next year. We're consistently looking also at these portfolios to ensure that they're well diversified, but also we're getting exposures to asset classes that make sense in the current environment. So once again, just a big thank you, and we'll see you next time.
Great. Étienne Joncas-Bouchard, thank you very much for joining us here today at Fidelity Connects.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.